This is Diane Kennedy, and I love these webinars where I get to bring an expert in that I'm really interested in learning the information about. Marco and I go back a number of years. I first met Marco because he's an expert in helping businesses build credit, and he's helped a number of my clients start off with new businesses and just get on the right path for building business credit right away so they're able to go out and get big loans to invest in real estate or in expanding their businesses. But today what we're going to focus on is a lot the personal credit. The things have changed a little bit. Personal credit is now more important than it used to be in building your business credit. But you know, I'm going to just turn this over to Marco and let you run with it, Marco. Thank you for taking the time today to talk about this.
Oh, thank you so much, Diane. It's a pleasure to be here today. I want to thank you for this opportunity to share some really exciting information. Something I'm very passionate about is the credit industry. I've been involved in this industry for over 20 years, and working with business owners and consumers alike, you know, credit is something I just love. I love talking about it. And for those of you who are on this conference call, I'd like to first congratulate you for taking some time out and learning how you can rebound, recover, and maximize your credit scores. And like what I'm going to talk about today is more of your FICO scores. And I'm going to share with you why that particular scoring system is so important. So without further ado, let's get started. And what I've done here is put together pretty much a step-by-step way for you, regardless of what you went through. If you went through a bankruptcy or you've lost your business, unfortunately, due to tough economic times, we're going to share with you how can you recover. What can you do to come back and improve your credit score? Now, the reality of today, what's going on is, you know, we know we've gone through a real tough financial era since the Greatest Depression. I mean, all of us know someone who's went through tough times, who lost their home due to foreclosure, or you may know someone right now who's going through a short sale, or they lost a job, went through a divorce. There's all different reasons, and credit used to be voodoo. It used to be really tough talking about credit. It was a very private thing, but today, we as an entire country, we know so many people have gone through credit challenges that talking about credit problems is almost something that's talks about in a conversation. If you tell someone, well, I had a repossession, unfortunately, and then the person you're talking to said, well, I had a repo, a tax lien, and a foreclosure, so you know, I have tougher times than you. So it's not as much voodoo anymore talking about credit. But if this is really startling right now. In the past year, nearly 65% of our country has not even ordered their credit reports because they don't want to know what's on it. And that's just the reality. But the key thing is you can do something about it. And nearly 70 million people are unaware of what their current FICO scores are. And we're going to share with you some information today, but more importantly, I'm going to share with you some meat and potatoes, some things that you probably have never heard of, that what you can do right now and continue to do to make sure you improve, rebuild, and maximize your FICO scores. Now, about 43 million people right now have less than 599 FICO score. That's kind of scary. And many of the people out there, you know, we're going to talk about what is excellent credit. How do I get the A+ credit rating with the best rates out there? The number used to be 720. Today, that number is now 750 or greater. That's A+ credit. We're going to talk a little bit more about that in the upcoming slides. Every 3 seconds, an identity is stolen. So just think how many people, after this presentation, have had their identity stolen. Now, this is something really powerful. 50% of employers use credit scores. I was talking to a gentleman this week, Diane, that this blew me away. He works actually at a casino, and his gaming license, every year they do a review of his credit. If there's any derogatories on his credit, he'll get fired. I mean, that's his whole entire job and career is based on his credit. They will not renew his gaming license. So that's just really, really startling. So why is FICO scores, why do they matter? Why are they important? Well, first of all, they're used by 90 of the top 100 lenders in this country. So I know you probably heard of all these different types of scoring systems like Vantage Score. There's even educational scores out there. The number one thing you need to focus on is FICO. That is the number one scoring system that's used. more than 90% of lending decisions in this country are based on FICO scores. It's the most commonly used credit risk score in the United States, and it's basically the standard for measuring risk for the banking, mortgage, credit card, auto, and retail industries. So don't confuse your FICO scores with some of those sites that say, well, we'll give you a free credit score. Like there's sites like Credit Karma and Quizzle. Those are educational scores. Those are not derived from your FICO score. So if you go to, for example, one of these sites and they provide you a credit score, most likely your scores will be 20 to 30 points off of your actual FICO score. So that's where, unfortunately, some people say, well, I have a 680 score. I pulled it off Credit Karma, and they go to apply for a credit card. They get declined because it's a 650 and there's some other thing, issues, or et cetera. So don't confuse your FICO scores with your educational scores. Now, you may get a little overwhelmed with the information I'm going to share with you, but the goal here is at the end of this presentation, you're going to be able to receive this entire webinar absolutely free, so you can play it over and over again. And but this is very educational for you to understand that the FICO scores. There's other names for them as well. And FICO is a separate company, and then you have the main credit reporting agency, Equifax, Experian, Transunion. Equifax uses Beacon and Pinnacle scores, and those are just different names for FICO scores. They're pulling their data from FICO. Experian uses FICO Risk Model, FICO Advanced Risk Score, and Experian Fair Isaac Risk Score. That's the older name, the Experian Fair Isaac Risk Score. TransUnion uses FICO Risk Score Classic, FICO Risk Score Next Gen, and Empirical Score. So if you go to TransUnion, and you'll see on the TransUnion website that you can get your credit score from TransUnion. They're just pulling their information right from FICO. So remember, again, don't confuse your FICO scores with educational scores. Now, to make matters worse, there's over 50 FICO scores that you may have, 50, and there's 6 different flavors. And what I mean by that is because lenders, and when I'm going to show you the slide, it's going to set you back a little bit, but most people believe there's only one FICO score that you have with each credit reporting agency, but the creditors, lenders, bankers, the credit card issuers, they actually can pull different types of FICO scores from FICO. You only know about your generic FICO score, but there's also a score called the FICO Mortgage Score, the FICO Auto Score, the FICO Bank Card Score, the FICO Installment Loan Score, the FICO Personal Finance Score, and all of these scores are obviously tailored to different types of industries. So one thing I just want, and I know many of you this may have happened to you, where you went and pulled your generic FICO score, you went to myfico.com, you pulled your score and say, great, I got a 720 and I got a 690 and a 730. Then you go apply for a mortgage. The mortgage company pulls a tri-merge credit report, and their scores are a little different than yours. And you're confused. You're like, well, I just went to my FICO, and it tells me these are my scores. Well, it's because the mortgage company may have pulled a FICO mortgage score on you. So that's just a little education for you to understand why there's different variations in FICO scores. And more importantly, why could you have 50-plus FICO scores? Because FICO comes out with new versions of their system every time. So just like we're using, if you're using Windows, there's Windows 8, there's Windows Vista, there's Windows 07, there's different operating systems, right? But if you don't upgrade your Windows, what happens? You may be using an older Windows system, whereas someone else may be using the Windows Vista, someone may be using Windows 08. Same thing with lenders and creditors and banks. They may be using an older FICO scoring module as opposed to the new updated ones. So this is very a confusing industry, and I want to share with you today what you have control over. So it's important to remember not all FICO scores are created equal. So this particular roadmap, it kind of makes it simple for you to understand how the whole scoring system works. You'll see that you as a consumer, when you make your payments, these lenders report your payment activity to the credit reporting agencies. And I'll point right here, there's Equifax, there's Experian, and TransUnion. It's important to realize, though, that lenders, they subscribe to these credit reporting agencies, and they may not supply the data to all 3 agencies. They may subscribe to one agency, and that's why credit reports have different types of items on them. So once you apply for a loan down here, the lender is going to request a credit report and a credit score. FICO is going to get his information from each of the credit reporting agencies and send it back to the lender, and that's why you have different variations of credit scores. So that's kind of the cycle or the map of the whole entire system. So how is your FICO credit report card? Are you making the grade? And this is kind of like your report card. I know, Diane, you and I were talking about, you know, what's good credit today? What do people need to shoot for? Now, the A rating, 750 and above. That's the new score where you want to shoot for to get pretty much the best available rates. Now, of course, there's other factors that play into you getting approved. For example, your debt-to-income ratio, your income. So lenders use different criteria, but as far as FICO goes, this is the scoring system. So now, like I was talking about earlier, don't confuse your FICO scores with your educational scores. So this is another really important data that I want to share with everybody, because this is going to kind of show you FICO did this research on credit recovery and what they believe, how long it takes for you to recover if you go through a foreclosure, if you go through a 30-day late on your mortgage. And this blows my mind, because if you look at this chart here, and if you have a 680 credit score, and you started with the 680 credit score, and let's say you have one 30-day late on your mortgage, your score is going to drop anywhere from 60 to 80 points from one 30-day late. And what they're saying down here, it's going to take you 9 months to recover from that one 30-day late. Well, if you had a 720 credit score and you experienced the same 30-day late, look what happens to your score, and look how much longer it takes for you to recover, 2.5 years, just from that one mortgage late. So this chart right here is pretty powerful, because it kind of shows you, a foreclosure can charge a 200 plus point hit on your credit. And this is just from one item, one derogatory reporting on your credit report. Now, we all know some of us may have a 30-day late payment, a 90-day late payment on mortgage, may have a short sale, a foreclosure, or even a bankruptcy. You may have multiple issues like this. So think about all these issues. If you're experiencing, and this is just in mortgage, you may have had a repo, a charge-off, or whether it's a tax lien. Well, what can you do? Obviously, I'm sharing with you all this pain out there, and you're probably like, yep, I know people have gone through that, or I'm going through that myself, but what can I do? What can I do to come back? Well, the good news is you can leverage the FICO scoring system to your advantage. And how do you do that? Is you have to learn how to play the game. You have to learn the system. Now, I'm here to share with you a very simple way to learn the system. And it's not going to take you to take an educational course or go to school or anything like that. I'm going to share with you the game board. This is our game board, what you see on your screen. Now, you've probably seen on the FICO website, they have this pie chart. But I like to use this as, call it our game board. Just like you have Monopoly, you have Life, this is our credit score game board. And the payment history is 35% of your FICO score, 35%. And I'm going to share with you how to improve your payment history, how to recover from having a charge-off, from having a bankruptcy, from having a tax lien, etc. 30% of your credit score, your FICO score, is from your debt-to-credit ratio, how much debt you have compared to how much credit is available. I'm going to show you today on this webinar some strategies on how to leverage the debt that you have, how to improve your debt-to-credit ratio. The length of credit history. Now, some of you may have had credit cards that you had for 5, 10 years, and now they're charged off. So you lost all that credit history. They're not active anymore. They're charged off. Are you telling me I have to open a new credit card and I have to wait 2 to 5 years before I have good credit history. No, I'm going to share with you today on how you can instantly add 5, 10 years of credit history, and it's completely legal, it's completely compliant, and it's completely approved by FICO. So I'm going to share with you that today. New credit. Again, this is 10% of your score. And I'm going to share with you what type of new credit you should be opening up. And more importantly, how to know that you're going to get approved before you apply. See, most people kind of do the, throw the mud at the wall and see what sticks. And you don't want to do that because then you risk having excessive inquiries, and that can hurt your credit even more. So wouldn't it be beneficial to you to know which credit card companies and which lenders, which credit bureau they pull from, and what credit scores do they require for you to get approved? What if you knew that information? That would be invaluable to you, wouldn't it? Let's suppose you have a strong Transunion credit report, and your Transunion FICO score is let's say 690. Well, wouldn't it make sense for you to apply with credit card companies or creditors and banks that pull from Transunion because that's your strongest report, that's your strongest score? That's what I'm talking about, leveraging the FICO scoring system to your advantage. Account diversity, this is huge. We're going to talk about that. Now, it's important to realize there's over 88 negative rating factors in the FICO scoring system, over 88, but you have control over 5. So what I encourage you to do is don't beat yourself on the head trying to decipher and figure out this FICO score algorithm, mathematical formula, etc., this black box secrets that they have. You'll never find it out. You have to deal with what you have control over. What can you do to maximize your FICO score? So step number 1, we're going to address payment history. Is there anything that I'm missing? Diane, did you have any questions so far?
It's interesting, Marco, when you showed that graph a couple of slides ago, and the person with the higher rating who had something, if it was late 60 days or there'd been a foreclosure or something like that, they actually seemed to get hurt worse than the guy who had the lower rating. And that doesn't seem intuitively right, but it's interesting to see, hey, this is what you're dealing with.
Right. Yeah, it's almost if you have great credit, if you make a mistake, you're going to be punished even more.
Right. So. Okay, so that's why this is even more important than for somebody who has had something happen. And boy, I got to tell you, a lot of people in my group, my clients, have gone through foreclosures because people were in a lot of real estate that went down, and when the market turned, there wasn't anything they could do about it.
Right.
So,
yep.
Great information. Thank you.
Thank you. And well, now there will be something for them they could do about it, which is definitely this is step number 1. Sure. For those of you who've gone through credit challenges, if you have a foreclosure or you have a charge-off, collection, judgment, whatever the derogatories you have, most people think, okay, I've gone through all this, I've gone through bankruptcy, everything's discharged, I'll just open up a couple of secured credit cards and start all over again, start rebuilding my credit. And what they're missing out on the most is the largest factor that's impacting their credit score, and that's their payment history. That's all the derogatories that they currently have on the report. And for those of you listening to this call, you may be thinking, well, what can I do about it? I did go through a bankruptcy. I did have a foreclosure, or I was late, or I did have some collections. Well, it's important, first of all, to realize that the credit reporting system is a flawed system. It's a deeply flawed system. And what I mean by that is the data, the billions and bits of information that's being entered and shared among suppliers, data receivers, etc. There's laws that are put in place to protect you as consumers. You remember, these are businesses. They are in the business to make money. They're in the business for profit. What they do is they compile data on you, and they sell that data. They sell that credit report. They sell those credit scores, and they sell it for a profit. Now, that information on your credit report has to be verified. It has to be accurate. It has to be reported. Now, you have every right to challenge derogatories on your credit to ensure that in fact they are accurate. I can share with you some incredible stories of clients that have gone through a foreclosure, but it was deleted by the credit reporting agency. So ask yourself, why would the credit reporting agency delete a foreclosure that actually happened? because they're not complying with the law on how that information is collected, how it's entered into their credit report. See, credit reporting agencies we're not deleting our service with what we do. We're not deleting that. The credit reporting agencies are. So it's just like going through checks and balances. So at the end of the year, when you have a bookkeeper who goes through your finances, or your accountant, like someone like Diane, who goes through your accounting for your business, she makes sure all the I's are dotted, the T's are crossed, to make sure all the money that came in and the bills are, the bills that you paid, the invoices you pay your employees. She does the checks and balances. This is the same thing with your credit. You have to do a check and balance on your credit, even though you've got derogatory credit. Now, whether you have all these derogatory items that you see on the screen, I'm going to let you know that there is a way to recover, and that's through credit restoration. And you have some options. You could do it yourself. You have every right to repair your own credit, okay? Just like you have every right to fix your own car. Your car breaks down, you can change the tires. We all know how to change tires, but what do we like to do most of the times? We'd rather have a certified mechanic work on our car. We don't want to figure it out ourselves. We don't want to hire someone who does have no experience in working on a car, work on a car. We want an expert to work on a car, because that takes us to our job. It takes us from A to B. So you have every right to work on your credit yourself, just like you have every right to do your own taxes. Now, Diane, I know you're going to love this, but I'm sure you've experienced people who've done their own taxes before and have lost thousands of dollars in possible deductions.
Oh, yeah.
Or they made mistakes and you had to go back and redo their taxes because they made mistakes on their previous filings. So if you want to do your own taxes, by all means, go for it. But there's over 73,000 pages to date on the federal the tax law. So do you have time? No one understands the tax law. It's so complex. So that's why, what do? We hire experts like Diane Kennedy to handle our taxes. And this is on a personal side. Imagine if you own a business, So my point is, yes, you can do it yourself. You have every right to. But at the same time, if you're going to do credit restoration yourself, there's quite a bit of things that you need to realize what you're going to be in store for. Okay? And if you've got the time, go for it. Absolutely. But if you don't have the time, there are some solutions. Well, remember, if you're going to do it yourself, you need to order your reports. You need to get your credit scores. You need to analyze those reports. And you need to decipher all the items that are damaging your FICO scores. And you have to understand what those items are. All right? You also have to craft an effective dispute for each of the items you identified that are derogatory on each credit report with each credit reporting agency. And then you have to craft proper dispute documents for each credit agency. Then you're going to send those disputes out, and you're going to have to follow up on your own. You have to follow up with each dispute cycle. When you receive those updates, what else you got to do? You got to track those updates and reprocess a new cycle yourself, do the complete analysis, and do this whole process over again. So you have to do this all yourself, and you have every right to do it. Okay? But I don't know about you, but I value my time. I don't want to deal with it. So if you don't want to deal with repairing your own credit, you can have it done for you. Now, in this particular webinar, I can go on and on about credit repair companies that are very irreputable and of course, that don't do the correct job, that have given the industry a bad name. Myself, I've been in the credit industry over 20 years. My primary service is working with businesses and my business credit building system. I've been processing credit restoration through our processing center for over 10 years. And just so you know, if you want for credit restoration, the reports are pulled for you. It can be all done for you. All your scores are pulled for you. Saves you time, saves you stress, saves you from making any mistakes. Faster, easier, and smarter. It's an effective approach, and it's a 1 full year of credit restoration. So that's an option for you, and that's what I'm here. This is a shameless plug on my credit restoration and what we do, and we help with our business owners. We'd love to help you. 10-year track record with our credit restoration, A+ rating with the Better Business Bureau, and today we've had over 660,000 deletions today. And if you'll see on this little chart here, Over 70,000 public records deleted, judgments, tax liens, garnishments, bankruptcies. This is something really kind of humorous that I wanted to share with everyone. Diane, we had a customer that went through the credit restoration, and after 2 cycles only had 1 deletion. He had about 20 derogatories on his reports. And it was during December last year, and this is going through the 3rd dispute cycle. And what happened is that he was sending the disputes out that our process center created for him, set up for him. And what he did was he actually put stickers all over the dispute documents as a joke and wrote Merry Christmas, et cetera, et cetera. The next month, all the items were deleted off his credit reports. All of them. So
the stickers worked, huh?
Yeah, his little stickers, just throwing them on the disputes that we crafted for him, it was just hilarious. And it's important that the reason I'm saying that, folks, is understand this. If the credit reporting agencies verified that these derogatories were accurate the 1st month, the 2nd month, then why on the 3rd month did they delete them all? See, that's a question that makes you wonder, how flawed this system is. Now, step 2 is leveraging your credit usage ratio. Now, this is extremely important because this is 30% of your FICO score. Now, what they look at is 4 different things: the total amount that you owe, the number of accounts with balances, the debt to credit utilization on revolving accounts, and the balance on installment loans. Now, the thing that's really, really important with this is the fact that you probably heard through many different websites or that 50%, just keep your credit to debt ratios under 50%, that's the golden number. Well, that's not the golden number, not even 30%. I'm going to talk a little bit about that, which I think is going to kind of set some people back on this conference call, but I'm going to share with you what the top 800 people with 800 credit scores, what their debt to credit ratios are. And if you keep these ratios, you're going to see some dramatic improvements on your FICO scores. Now, how do you leverage your credit usage ratio? Well, you can pay down your debt. Second, balance transfer. Now, for example, if you're on this conference call and you have, let's say, 2 credit cards, and each credit card, let's say, has a $1,000 credit limit. If one card you owe is maxed out, let's say, and the other card you have a $1,000 available credit, do you realize you have 100% debt to credit usage ratio on that one card, which hurts your FICO score? You can easily fix that. You can transfer $500 from the one card onto the other card that has a $1,000 available limit. Now at least you have a 50% debt to credit ratio spread out over 2 different cards. Okay, that's a lot better than one card with 100% maxed out. Then it's better to have 2 cards at 50%. So you want to make sure that you're always at, let's say, 50%. Ideal is going to be 30%, but the cream of the crop, I'm going to explain in a minute where you really want to be with your credit to debt utilization. Now, another thing you can do is you can also request a credit limit increase. Now, do not request a credit limit increase unless you have great payment history, obviously, with the credit card. So let's say, for example, you have that same $1,000 credit card, and let's say you owe $700 on it. You only have $300 available credit limit. Well, that means you're at above 50% debt to credit ratio. But what if you paid on that card, you've had it for years, and you requested an increase? What if they increase that card now to $2,000? What happens is now your debt to credit ratio completely changes because now you have a more available credit and less debt on that particular credit card. So these are just little things that you can do that can make a dramatic impact on your FICO scores. Now, this is where I want to share with you on the ideal debt to credit usage utilization. If you'll see on this chart, and this is put out by FICO, is those with a 730 plus FICO score maintain a 1 to 20% debt to credit ratio. 1 to 20%. So the whole 30% notion, those are people with 695s, et cetera, but 1 to 20%. See, look at the people with 0%. I love listening to people who say, well, I don't carry any debt. I pay my credit card off every single month, so I don't carry any debt. Do you realize that actually hurts you not to have debt? Now, unfortunately, that's how the scoring system works. They want to see you have debt, but a small amount, controllable debt. Now, it's important for those of you who max out your credit card every month but pay it off every month. Do you know that still can hurt your credit score? Well, how does that hurt your credit score? Because your reporting date is not the same as your statement date. So the creditor or the credit card issuer may report your balance that you owe, and let's say you pay it off, your statement date is a week after. So it can still show up on your report that you maxed out at one time, then the next month it show that you had zero balance. So how can you avoid from that impacting your FICO score? Well, number one, you can find out when is the reporting date and when is the statement date with that particular credit card issuer. And this is a lot of work, isn't it? The other option is just never charge more than 30% on your card. So if you have a $1,000 credit card, don't charge more than $300 on it. I mean, this is the game, folks. This is how it works. This is how the scoring system works. The fact is, according to FICO, the average credit usage ratio of a person with an 800 credit score is 7%. So in your mind, I want you to realize if you have a $10,000 limit credit card, as long as you know when the reporting date and the statement date is, you can max out that card and pay it off the next month. But if you don't know those dates, you can really hurt your score because you'll be maxing it out every month. Now, step 3 is your payment history, or adding credit history. This is huge because how long your accounts have been open and the length of time since the last activity on each account is paramount to this particular to calculating your FICO score. You probably heard the term, the best credit is old credit. But for those of you on the call, maybe all of your old credit has been charged off or has been closed. So what can you do? How can you add credit history on your credit reports? Well, you can piggyback on someone else's credit. Now, you've probably heard this term about adding authorized users, and for a while, FICO did away with acknowledging authorized users on credit reports. But what happened, there was a huge amount of backlash, and they did reprove that. So now you can add authorized users on your card, but with the new FICO 08 module, they do know how to differentiate. No one knows how, but they know how to differentiate a legitimate authorized user from an illegitimate authorized user. So I want to talk to you a little bit about that. But what is piggybacking? What does that mean? How does that work? Well, basically, in a nutshell, if you know a family member, your spouse, a domestic partner, anyone that's related to you, if they have a credit card that they've been using for years with excellent payment history, they can add you as an authorized user on that card. And what happens is you inherit that entire credit history on your credit report. Now, this doesn't mean you're going to have access to that credit card. This doesn't mean you can call their credit card company and say, hey, can you send me a card? You have no permissible purposes on that card. Like you're not authorized to use that card. More importantly, this is not a joint account. This doesn't mean that you're liable for your family member's credit card because they added you as an authorized user. It's the simplest way to add credit history. On the flip side is the family member who has the great credit card, there's no impact to them either. You don't get, you're not a joint account holder. Nothing that they do by adding an authorized user affects them whatsoever. But the one thing you need to be careful of is if someone adds you as an authorized user, if they all of a sudden start maxing out that card that you were added to, or they stop paying on it, that will affect your credit history. Okay, so you make sure that if you want to be added as an authorized user that you pick someone in your family or your spouse who obviously has great track records. So you want to choose a legitimate primary account holder. This has to be a spouse. It has to be a family member, relative, or domestic partner. That's what FICO determines is a legitimate primary account holder. You can't just go ask your buddy or more or less definitely don't pay to be added. There are some services out there that say we'll add you as an authorized user, and they'll actually make you pay thousands of dollars to do that. Do not do that, okay? Because it won't work. Also, you want to select a 5+ year account, ideally. So if you know, at least 5 years credit history would be huge for your FICO score. And you want to also, before you get added, you want to make sure that the family member that or your spouse who's going to add you as an authorized user, they need to contact their credit card company, and they have to inquire if that credit card company reports authorized user data. They have to find that out, okay? Because if they don't, then there's no sense adding you as an authorized user because you won't benefit. There are some credit card issuers that will only report authorized user data if you're a spouse only. Capital One actually allows you to add an authorized user right on their website. So that's kind of cool. And once you've verified this, then you can become an authorized user. Have them add you on there. Okay, so FICO estimates that 50 million consumers right now are legitimate authorized users on someone else's credit card. FICO acknowledges this and recognizes this, and they're fine with this practice, folks. It's the ones that if you're going to someone you don't know or a friend or a buddy, that's when you do not want to do this practice, okay? Step number 4. This is 10% of your FICO score. It's adding some positive and active trade lines. When you close credit cards, you know, you're losing out on something very valuable. So definitely don't close credit cards. But if you've gone through some credit challenges, you need to establish some new active positive trade lines. So if you're currently, let's say, renting right now, you have no credit cards, you don't have a car loan or anything like that, and you just have derogatory credit, you need to start establishing some positive trade lines. So you only want to deal with mainstream credit card issuers. There are credit card issuers out there that you know will promise you this. Do not deal with credit card issuers that are not mainstream, because that actually can hurt your credit. And we're going to share with you how we can provide you those mainstream credit card issuers absolutely free after this webinar. You also want to open a credit card with a credit card issuer that reports to all 3 major agencies. There are some secured credit cards out there that only report to one agency. You want a credit card that reports to all 3. Secured credit cards, $300 to $5,000. You can open up a secured credit card today for $300 to $500 secured. You make a deposit, and that's your credit limit. You have to start somewhere. And I'm going to share with you, you know, after 6 months, you can actually increase that to an unsecured credit card. Now, you want to also leverage your credit usage ratio, which we talked about in step 2. So when I share with you how you use your credit, you stay under 30%, ideally stay under 20%. So let's just say you opened up a $300 secured credit card. Well, then you never want to charge more than 20 to 30% on that card. Okay, and you may even want to keep anywhere between a 1 to 5% balance on the card, so you're always making payments. And even if it's a small payment, you're building credit history and you're building usage. But you want to keep that debt-to-credit ratio ideally under 20%. If you go to 30%, that's okay, but ideally 20%. So you're using this strategy right there. And imagine if you do that with 2 or 3 secured credit cards. And after 6 months, you can request a review. And that doesn't hurt you. It's not a credit inquiry if you have an existing account with a credit card issuer and they review your account. They could determine, and that's a soft pull because you already have credit established with them. So don't worry about that being an inquiry. But you can also inquire with the credit card issuer if it's going to be a hard pull or a soft pull when you're asking for a credit limit increase. Now, the caution here is do not close any established credit cards that you have right now. If you have an active card that you're paying on and you have some credit limits, even if it's a department store card, don't close it because that'll trigger the trade line to become inactive. Now, when I'm talking about adding 3 to 4 active positive trade lines, I'm talking that's what you should minimum have on your account, your credit reports reporting. It's 3 to 4 active. So if you have, let's say, 1 credit card right now and you have a car loan, you have 2 active trades right now, you need to have at least 3 to 4. Now, another aspect of this game here is step number 5, is diversifying your trade lines. So we talked about secured and eventually updating those to unsecured credit cards. You want to have some department store cards, and this is as you're improving your credit score, you're going through credit restoration, you're leveraging your debt to credit usage ratio, you open up a couple trade lines, then you're going to look at obtaining some department store cards, maybe 1 to 2 of those, gas cards, 1 to 2 of those, an installment loan that's not mandatory, but these are just the diversity of credit that you can have on your account. An auto loan, a lease, and a mortgage. Again, the mortgage is the Mac Daddy of credit. When you have that on your report, that's like one of the most powerful trade lines you can have. Now, you want to make sure you always leverage your strongest credit report and FICO score when applying for credit. When I talked about earlier, when you know where your scores are at with each credit bureau, and you know let's say you have a 650 with Transunion, that's your score, and let's say you have a 610 with Experian, and you have a 605 with Equifax. Well, you want to utilize the report that has the strongest score. So when you're applying for credit, and let's suppose you want to try to get an unsecured credit card, you're going to utilize your report that has the strongest score, and you want to identify which creditors will pull from that particular bureau, that particular credit agency. Now, how do you find that out? Well, at the end of this webinar, I'm going to share with you how you can get this free information. We provide you resources where you can find out where main companies like, for example, Barclays, that's a credit card, they actually pull from Transunion, and they pull your score from Transunion. So if you want to apply, you have a strong Transunion credit report, and you have a strong FICO score, then you can apply it for a Barclays credit card. And if you have a Capital One pulls from all 3 credit reporting agencies, but they pull their scores from Experian. So this is what I mean is when you know that information, that allows you to leverage the game. It allows you to leverage your scores to benefit you. Step number 6 is inquiries. Now, there's different types of inquiries. There's soft pull inquiries and hard pull inquiries. Now, as you're applying for credit, you know, if you know what creditors are requiring for you to get approved, then you're not going to need to worry about excessive inquiries, because when you apply, you're going to get approved. When you're getting secured credit cards, there's automatic approval credit cards, and there's secured credit cards that you can also be declined. For example, even though Capital One has a secured credit card, they still can decline you if your credit is not up to where the standards of getting a secured credit card. So you don't want to think, well, just because it's a secured credit card, I'll get approved. No, there are some credit card issuers that still will not approve you, even if you're going to deposit the money to secure the line. So when you take advantage of our 7-step course, which is absolutely free, we're going to provide you the secured credit cards that will approve you no matter how bad your credit is. All right. Now the soft pull inquiries, hard pull inquiries. You know, soft pull inquiries are when if you go order your credit score directly from MyFICO, that doesn't hurt you. If a credit card company is soliciting you for a pre-approved credit card offer, that does not hurt you either. The hard pull inquiries that do hurt you is when you go out and apply for credit. You go out and say, hey, I want to apply for a credit card. You fill out the information, your social security number, or you go apply for a loan. That's your hard pull inquiries. And you'll see the overall population distribution on the right here for hard inquiries is about 1 to 2. More than 6 inquiries in a 2-year period, in a short period of time will hurt you the most. But inquiries are supposed to drop off every 2 years. I say no to 2 years. I think that's way too long. So, I mean, if I'm trying to, build up credit, you're going to need to apply for credit. So I believe that you have every right, of course, to submit an inquiry dispute and work on removing excessive inquiries. So it is an option that you can do, folks. And we will show you how to dispute inquiries directly with the creditor, step number 1, and how to dispute the inquiry with the credit reporting agency. We had one particular customer. He had 15 inquiries on his one credit report. What happened is he went to, I think it was a car dealership, something like that, and they actually shopped around like 7 different banks, and he said, just check if I can get approved with this bank, because it was a bank that he did business with. They didn't listen to him. They checked 7 different banks, and he had 7 inquiries. And now he didn't take a major hit because he was shopping for one particular auto, but he was really upset because that was 7 inquiries on his credit, and he had other inquiries because he was getting some credit cards, etc. So we basically used this dispute document, this step-by-step disputes process that we shared with him in our system, and he had all 15 inquiries deleted in 20 days. 20 days. Now, is that going to happen for everybody? No. But again, you use our document, send it certified mail, and you can have some great results. So just say no to 2 years. Step number 7 is protect, manage, and maximize your new FICO scores. Now, it's important as you're going through this entire process. Everything I'm sharing with you in this webinar, of course, there's much more details that we provide in our step-by-step system. I'm trying to give you as much information as possible. But the key is now protecting and managing and maximizing your new FICO scores. But it's important to realize the Fair Credit Reporting Act is a self-policing law. It's up to you to police your credit reports. It's up to you. In the credit reporting industry, you are guilty until you prove yourself innocent. So if there's something on your report that even it didn't even happen, guess what? You have to prove that it didn't happen. If you even go through identity theft, or if there's a late payment that showed up on your credit report and you were not late, or you may have gone through a divorce, and in the divorce there may have been an agreement where your spouse was supposed to pay this credit card and you were a joint account holder, and all of a sudden it showed up and your spouse never paid it off. That happens. So you have to be able to protect, manage, and maximize your FICO scores. So while you're rebuilding and repairing and reclaiming your excellent credit, you have to continue to protect it and monitor it. So I think it's extremely important that you monitor your credit. You have identity theft protection and credit restoration. Your credit usage ratio, which we talked about, how to continue to use that strategy month to month. This is not a one-time thing, folks. This is how you need to manage your credit all the time. You should have a credit coach. Now, when you're a customer of ours with our credit restoration, you receive your own credit coach. And because you're in credit restoration, you're going to be able to monitor your credit every single month, actually 24/7, 24 hours a day, 7 days a week. So during the credit restoration process, you're not only able to repair your credit with our service, you're also going to be able to monitor your credit, and you'll have your own credit coach. So anytime you have questions, even with information like we have here, your credit coach, you can call them Monday through Friday, 9 to 5 Eastern Standard Time. So we provide that to you as a customer of our credit restoration. And step number 3, to maximize your FICO scores, is creditor pre-qualification. And what that basically means is, like I talked about earlier, is when you know the creditors, which bureau they pull from, what the score range is to get approved, that's how you maximize your FICO scores, because then you know you're getting the best rates, you know you're getting approved, so you don't have to shop around. Now, the 7 steps to superior credit, it's a $497 value. I am providing that to everyone on this webinar absolutely free. There's no strings attached. There's no upsells or anything like that. Why would I do that? My goal is to educate you, empower you, and of course, our goal is to help you with your credit restoration. We want you to enroll in our credit restoration service so we can help you rebuild your credit, and we can also help you get the secured credit cards that you need. And in our course, you're going to receive everything on this webinar step by step in an email system. So we get in more detail. We'll give you links to the specific sources to apply for credit with. We give you even a $100 discount off our credit restoration service. Our credit restoration service is a 1-year service. It's a flat fee. It's normally $4.99. It's $3.99 for everyone participating on this webinar, so you save $100 off. And we do have payment plans. We're going to provide you a list of our best secured credit cards, personal and business credit resources for those of you who are business owners. You realize when you get your credit score up to 680 or greater, and you utilize the information I'm talking about, leveraging your debt-to-credit ratio, keeping it under 50% at least, and you remove the derogatories, the public record items, do you realize when you get to a 680 plus credit score, you can qualify for business credit cards as a business owner. And these business credit cards do not report to your personal credit reports. They do not report to your personal credit reports. They report to your business credit files. So we can give you access to those business credit card sources once you improve your FICO score, because this particular program is FICO driven. We're going to provide you the inquiry dispute documents, the credit pulls database resources, so you know which credit card companies, which credit card issuers, which bureau they pull from, and what scores. We're going to give you the resources where to find that information. And you're going to receive our Superior Credit newsletter. That's free. Doesn't cost you anything. You're going to receive ongoing discounts, special offers. We're going to keep you up to date on the newest trends going on personal credit, and we're going to even provide you business credit resources as well. All you need to do to take advantage of this is go to repairmycreditcourse.com. You simply enter in your name, enter in your email, and as soon as you click the submit button, what's going to happen is you're going to be taken to step number 1, which is what I covered here on this webinar, but it's going to provide you a video. It's going to show you how to take advantage of our credit restoration service, how to get your $100 discount, and then in 2 days later, you're going to get step number 2. It's going to walk you through everything. You're going to get your secure credit card resources, where to apply for them. So this is a step-by-step system, and it's yours absolutely free. And for anyone you know going through credit challenges, go through the system. Share this website with them, repairmycreditcourse.com. It's a step-by-step system for them to not only educate them, but help them repair, rebuild, and reclaim their excellent credit scores. So with that, I want to thank you for participating on this webinar. I know we're going to open it up for some questions. Just remember, it's not a shame to have a low credit score, but it is a shame to keep it. So you have to take action with the information that I'm sharing with you on this webinar. So remember, repairmycreditcourse.com. And we even provide you, once you opt in, an 800 number, and you can call and press extension 3, and I'll talk to you. I'll answer any questions you have regarding your credit. You have any questions about the credit restoration service, you have questions on the secured credit cards, or you have questions, you're a business owner, and you have questions on what you need to do to start establishing your business credit, whatever it is, take advantage. We look forward to working with you. And I'm going to turn the call back over to Diane. I know we're going to open it up for some questions.
And we have questions, so go ahead and get started on that. Hey, on the Amex card, American Express, how does that affect when we look at the utilization? Because typically American Express doesn't have a limit. It's like you can charge more than $1,000 or whatever. How does that work?
Oh, well, that's a great question. Well, basically how it works is anytime you max out your American Express, let's suppose you use it 1 month for $10,000. That's going to set your credit limit for that particular American Express card. So let's say the following month you should charge no more than $3,000 on that card, okay? Because your max usage on the card is $10,000. So if you know a set amount that you're going to use on the card every single month with your American Express, like you know you're going to charge at least, let's say, $5,000 a month to use it all the time, then at least you want to make sure that 1 month you charge on that card where it's going to keep that utilization at 30%. So
wow.
What would that be, like 12 or 13,000, I think, in 1 month?
Yeah.
Yeah, and then the rest of the months you keep it charged at the 30% ratio. So that's a great question.
Yeah, and I remember something you had told me. You mentioned it a little bit on the webinar. I'm one of those people who always pay my credit card off, and you were saying that's not smart. You leave something on there, like leave $100, because then you're using it. Correct?
Correct. But more importantly is your reporting date and your statement date. They're never the same.
Right.
So you don't, even though you're paying your card off at one time, if the credit bureau reports, I'm sorry, if the creditor reports that you're maxed out on that particular card because you didn't receive your statement yet and pay it off, it's still showing on the credit that you maxed out on the card at least one time.
Right, and then I don't want to pay it off completely, just leave balance running, correct?
Right, exactly. At least 1 to 20%. 1 to 20%.
Oh, okay, perfect, okay. This is kind of a longer question. I just got a credit report from all 3 companies, that's the Experian, Equifax, et cetera, and it shows that the HELOC, that's the home equity line of credit, for Experian and Equifax it shows it as revolving. Transunion shows it as other. How does that affect the FICO number?
Okay, so as far as it's showing as other, but it is showing the amount on there?
Yeah, it is. I'm guessing. I'm reading the question.
Yeah, if the amount is on there, it doesn't affect the score whatsoever. It's still the same amount. It still shows what they owe. Even if they're just classifying it different, that doesn't have any effect. Right.
Okay, good.
Because just so you know, like some people might say, well, if I have a short sale, how is that reported on my report? Well, there isn't an actual code for short sales on credit reports. They're either reported as a deed in lieu of foreclosure, or it's reported as a charge-off.
Right.
So even though you had a short sale, it won't show on your credit report short sale. So they have it classified as either a deed in lieu of foreclosure, or they have it classified as a charge-off.
Gotcha.
So their classification for a HELAC might just be other.
Right. Okay. So that wouldn't, in this particular case, doesn't matter as much. On those three, is there one that's always better, like TransUnion's always the highest score, or it varies from person to person?
It totally varies from person to person.
Okay. Boy, we're getting a lot of questions, just to let you know. A bank
well, that's a good thing.
Yeah, a bank that I had a loan with several years ago, and that loan's now been paid off, just checked his credit last month. And can they do that without permission? And did that hurt his credit score?
No. I mean, any creditor or lender that has a permissible purpose can check your credit, unless you put a lock on it.
And that was one of those soft inquiries, right?
Yeah, that doesn't affect you whatsoever.
Okay.
And you can lock your credit out too. If you don't want anyone checking your credit, you could do an opt-out. You could do an opt-out. I think it's optoutprescreen.com, or I think it's optout.com, and they can lock your account from any pre-screening for like 2 years.
Why would you want to do that?
You know, some people, again, it's just peace of mind. They just don't want anyone accessing their credit. I mean, it doesn't affect you or anything like that.
Okay.
But, you know, some people are very private. I don't want anyone looking at my credit.
Sure. Yeah. Got it. Okay. Question here on that 20% debt to credit. Would that also apply to HELOCs, the home equity line of credit?
Yes. Any revolving credit. Yes.
Okay.
Yes.
What's the best way to monitor credit?
Oh, that's a great question. I mean, of course, I'm going to do a shameless plug.
Okay. Yes.
You know, being in our credit restoration service, I mean, what that means is you're actually getting a credit report every 45 days in the mail from the credit reporting agencies. So you're actually getting the real hard data from the credit reporting agency. So as you're in our credit restoration system, you're able to monitor and track that because you're receiving a report every 45 days, and you're able to track that online 24/7. So that would be my first favorite.
You know, I've got to say, if you're actively building your credit, there's a fee to getting your credit reports. And so if you're looking at that every 30 days, by the time you figure that out, for the cost, you've got this on, you know, giving a $100 discount, so it's just $3.99. I mean, just pulling the reports for a year, it's about that cost without any of the other stuff. Yeah, I mean, I've done that before, and I've had to pay. I thought it was like $25 or $30 I had to pay to get those. So
yeah, I mean, there are some monitoring service that costs, you know, $20, $30 a month just to monitor your credit. Whereas, you know, if you take our $3.99 over the course of a year, that's $33 a month. So you're getting credit restoration, a credit coach. You're able to monitor your credit. You're getting all that for the same price that some of these credit monitoring companies charge.
Right. Oh, this is a good question because I know where this is coming from. I thought I heard you say before, and I think this was directed to me, that business credit doesn't have anything to do with personal credit, that you could get business credit without personal credit. And the question is, did that change? And the answer is yes. But then I'll turn it over to you, Marco, on that.
Yeah, that great question, by the way. Well, you know, in our industry and you know, with the serious economic collapse we had a couple of years ago, the game's changed. It changed a lot. And you know, while there are some really nice creative financing programs for business owners, I mean, it's amazing to me how creative some of these lenders get. But yes, personal credit, you know, getting personal business credit with no personal credit check, you know, that is available for supplier credit and fleet credit, et cetera. But when you talk about, you know, business credit cards, one of the popular programs we have right now, again, it's the business credit cards where they do check your credit. You know, that is a qualifying factor. but it doesn't report, once you qualify, it doesn't report your personal credit. Now, those particular business credit cards do require a personal guarantee. But we have our business owners anywhere between 6 to 12 months later, as they're using these cards, and these cards are sizable, $20,000, $30,000, $50,000 limits. They're having the personal guarantees lifted after 6 to 12 months of on-time perfect payment history. So, you're going to have to show the creditor, a credit card issuer, once you get these cards, that you're a good risk, you're paying on time, you can handle the debt, and you can get that guarantee lifted.
No, that's a good point. Now, you're still working with people who are building business credit as well, correct? I mean, these are like two separate programs. Yeah, but they often. Go ahead. I'm sorry.
Yeah, it's a two-step approach, because business owners come to us because they want to build business credit because their personal credit took a hit. Yeah. And what we do is we take them through the credit restoration 7-step system, and we're also building their business credit. So as they're building business credit and they're restoring their personal credit, we're getting them into a position where they're getting the funding they need, the best available rates. They're able to get the business credit cards that don't report to their personal credit reports. So it's a two-step system, and we don't want business owners just to build business credit and just kick their personal credit to the wayside, because that's doing them a disservice. They still need to have good, strong personal credit for their personal lives as well as their business.
Yeah, it's interesting. Actually, that's what prompted the two webinars you're doing. Is we were having a conversation about this, and I had remembered that, personal credit doesn't matter. It's just business. And you said, well, Diane, it's changed. And that's why it's so important to know somebody who's really got their finger on the pulse, because without you telling me that, I would have never known it changed. So, yes, personal credit does matter. But it's interesting because the 680 isn't one of the excellent scores. I think, isn't that like a C when you had your chart up there?
Yeah.
So it's just kind of like average, and then you can start getting the business cards. So that's cool. Another question here. You talked about mainstream credit cards. What is that? Is that just the Visa and MasterCard, or is something different than that?
Yeah, I mean, there's mainstream lenders, and there's also high-risk lenders. Okay. I don't want to name a high-risk lender because I don't want to get in trouble.
Yeah, okay.
But there are some lenders out there that are known in the industry to be high-risk lenders, and by having these particular credit cards with these high-risk lenders, you're automatically publicizing on your credit reports that you are high risk, because you obtain these credit cards from high-risk lenders that have ridiculous interest rates, just because you're trying to reestablish credit. So you're actually defeating the purpose, and unfortunately, many people are just trying to get back in the game and trying to rebuild their credit, and they don't know that using a high-risk lender can actually hurt you in the long run.
Right. And so how do they find that out? I'm going to guess you're going to say you're going to give them a list of good ones to use and just use these, right?
Right. We have a couple of mainstream secured credit cards that are mainstream lenders, and we provide that in our 7-step system. There's only a couple of them that we recommend that report to all 3 credit reporting agencies. They do have, and of course there are many of them out there, but many of them do require a higher deposit. So we wanted to identify the ones that don't require $500 or $1,000 to start. $300 is a good number. That's the lowest secured credit card we could find that fit all the criteria.
Mm-hmm. Got it. Okay. Okay. I have student loans of approximately $42K, and because I can only pay the monthly due and not pay any more, it says that with interest he owes over 100% of the original debt. How do you handle that to help the score?
Well, student loans is a different animal. I mean,
okay.
There's things that you could do with restructuring student loans. It depends if it's government-backed or if it's a private. They're dealing with a private lender, or they're dealing with a financial institution. So my advice is, of course, try to restructure that student loan if you can. Mm-hmm. I know you can defer those loans, but more importantly is you want to make sure that you can try to refinance it and get a better interest rate. But if you're only paying the minimum amount and you have your debt load, there's not much you can do unless you're looking to increase your payment amount or try to restructure it so you have a lower interest rate.
Okay, but does it hurt the credit utilization if it's showing that you owe more than 100%?
Well, there's different types of utilization. There's your total debt utilization,
Okay.
And then there's your revolving credit utilization. And then, of course, there's your installment loans utilization, like, for example, like your auto loans and your mortgages. So, with the revolving debt, that's where you have the larger impact, because, again, it's not as serious when you have a mortgage because, most people have a higher debt-to-credit utilization with a mortgage because,
sure.
that's a 30-year payoff with that compared to a credit card. So,
right.
There's not much of as great of an impact with the amount you owe on a student loan compared to a credit card.
Right. And so when you're using that 20% number, 20 or 30% number, you're talking about the revolving line, not including the student loan.
Exactly. I'm talking more towards the revolving lines because, who's going to go out and say, okay, I owe $150,000 on my mortgage. I have to pay it all the way down to 20%.
Right. Okay.
Well, so that's a great question. I'm sorry. I should have pointed that out.
No, it was a wonderful question. And actually, that is the end of the questions that we've got. But wow, repairmycreditcourse.com. I want everybody who's on this webinar to go get the free report. I mean, this is invaluable information. I know that I'm around this, and I learned things today that I just didn't know. I mean, thank you so much, Marco. And I'm looking forward to our next webinar. Do you remember the date on that? So when our next
you know what? I am sorry. I don't have that date.
You know what? I'm going to send an email out to everybody, and I'll be sending a note as well as far as where the replay is going to be. People that attended today, you may know somebody after learning this and say, I've really got to go talk to my friend or my son or my daughter or my brother-in-law or somebody about this. We're going to send the link, and you do have our permission to send it out to your friend as well so that they can come back and listen to it as well, because this is something we all need to be looking at and taking care of. We're not out of the recession. I mean, things are changing, the economic, we've got a new economy now, and so we all need to just be a little smarter in how we handle money and how we handle credit, and this is a big part of that. Marco, thank you so much for today. I've learned so much today.
Thank you so much, Diana. I really appreciate that opportunity. It's always great speaking with you, and I want to thank everybody for listening in on this Saturday, and I hope you got some great information and some meat and potatoes to help you go out there and improve those credit scores, FICO scores.
Yeah. Repairmycreditcourse.com. Thanks, Marco, and thank you all for joining us today. Have a great day.